back to Global Value. Today we're performing a fundamental stock analysis of United Parcel Service Inc., ticker symbol UPS. We're looking at UPS today as a subscriber request. Currently, the company is trading for $181.54 per share, and over the last year, their stock price is down 12.5%. Going back 5 years, it's a completely different story for UPS. Their stock price is up at a rate of about 11% annually. Over 10 years, they're compounding their stock price at 8% annually. And going back prior to the global financial crisis, over the last 18 years, UPS's stock price is compounding at a rate of 5% annually. Keep in mind that the company also pays out a large dividend. They have a 3.4 dividend yield currently, and their average dividend yield throughout this time frame would be in addition to these compounded annual returns in their stock price. So UPS is currently trading in between their 52-week high and their 52-week low. The company's down about $40 from their 52-week high, and they're up more than $20 from their 52-week low. UPS is a very large business that doesn't have a lot of short interest around it. They have about a $156 billion market cap. For more background about UPS, as the world's largest parcel delivery company, UPS manages a massive fleet of more than 500 planes and 100,000 vehicles, along with hundreds of sorting facilities to deliver an average of about 25 million packages per day to residences and businesses across the globe. UPS's domestic U.S. package operations generate around 64% of total revenue, while international package makes up about 20%. Air and ocean freight forwarding, truckload brokerage, and contract logistics make up the remainder. United Parcel Service Inc. was founded in 1907 and is headquartered in Atlanta, Georgia. So for our fundamental analysis today, we're performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of UPS based off their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over their last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital, so by asking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. UPS has earned significantly above average returns on capital in all 5 of these years. Their lowest returns on capital were just shy of 24% in their fiscal 2019. In the most recent fiscal year, the business earned 29% returns on capital, and averaged out over this time frame, UPS is earning 27% returns on capital in a given year. These returns are nearly 4 times better than those of a typical business. This is nearly twice our benchmark, and this is a big check to start things off here on metric number 1 for UPS. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric will be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time frame, UPS's revenues have grown by more than 40%, their earnings have more than doubled, and their free cash flows have grown by 45%. With their growth in their earnings and their free cash flows outpacing their revenue growth, this means that UPS has experienced some operating leverage here, and their margins have gotten slightly better over this time frame. Because all 3 of these are up, this is a check, and so far we're 2 for 2 to start things off for UPS. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business, and we're looking for earnings per share growth over the last 5 years. So UPS was a major beneficiary of the COVID-19 pandemic. In their most recent 2 fiscal years, their earnings are massively up over this time frame, and UPS has only marginally diluted existing shareholders in the business during this time. They've only issued about 0.5% of additional shares outstanding, meaning that because of their strong earnings growth, this is a check here on metric number 3. In their most recent fiscal year, UPS earned $13.20 for each share that they had outstanding. Next up, for metric number 4, here we're looking for free cash flow per share growth over the last 5 years for UPS. This is very similar to our last metric, and this is also going to be a check here for pretty much the same reasons. UPS has grown their free cash flows by 45%, and with just marginal shareholder dilution, their free cash flows are outpacing this massively. So recapping where we stand on UPS so far, because this is a check here, we're a perfect 4 for 4 through our first 4 metrics for UPS. Next up, for metric number 5, here we're evaluating how the business utilizes debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that will be at the greatest risk of poor potential outcomes based off these high debt loads. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over their last 5 years. So UPS has actually reduced their net debt position over this time. Currently, the business has just under $16 billion worth of net debt, and over their last 5 years, UPS has produced about $34 billion worth of free cash flow. This is more than twice their net debt levels, so this is a big check here on metric number 5. UPS looks like it is very strongly cash flow generative relative to the debt that they're employing in their business, and UPS produced $9.3 billion worth of free cash flow in their most recent fiscal year. So again, the company has benefited since the COVID-19 pandemic. With this check, we're perfect on UPS through our first 5 metrics. Let's see if UPS has what it takes to go a perfect 6 for 6 on our Select 6 analysis. So our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may offer us a reasonable starting point for a valuation of the business, and it may also offer a slight risk premium to the yield of the 10-year treasury. So currently, UPS has a $172 billion total enterprise value, and we're using their enterprise value because it's going to take into account both their market cap and their net debt position, and it's going to give us a more accurate perspective of the business that's more similar to as if UPS were a private company. So as we learned in their last 5 years, UPS has produced $34 billion worth of free cash flow, meaning that in an average year, the business produces about $6.8 billion worth of free cash flow. So when we divide their $6.8 billion of their average free cash flows by their $172 billion total enterprise value, that gives us just below a 4% average free cash flow to enterprise value yield for UPS. So that's just about in line with the yield of the 10-year treasury, although that's not offering us that risk premium we'd ideally be seeking. So because of that, coming in all the way at the end, this is our first and only X of the day on metric number 6 for UPS. You'll want to stick around until the end of the video because we've got a bonus stat to look at, and we want to find out what's a more concrete estimate for an intrinsic value of UPS. There's something interesting that you'll want to take a look at here as well. Again, in their most recent fiscal year, the company has produced $9.3 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for UPS, when we divide their $9.3 billion of their most recent fiscal year's worth of free cash flow by their $172 billion total enterprise value, that gives us about a 5.4% current free cash flow to enterprise value yield for UPS. So that potentially is slightly above that risk premium we'd be seeking. So because that's above that, that may mean that UPS is potentially interesting to still dig into at these valuations. Either way though, their average and their current free cash flows are split on either side of this 5% risk premium we're looking for. So keep in mind that this is not a buy or sell recommendation of any security. This is one of our 6 metrics, and these metrics are meant to be taken in holistically. While they are simple, when they're combined together, they can be very powerful. As a bonus, here we're looking at UPS's dividend profile. So UPS currently pays out an above average 3.4% dividend yield. So this yield is more than double that of the yield that you'd be receiving from an S&P 500 ETF currently. However, people make mistakes all the time by blindly chasing dividends. So it's important to stop and look at the underlying fundamentals of a business to determine whether or not that company is able to support their dividends using their free cash flows and whether their fundamentals look healthy. UPS has grown their dividends in all 5 of these years, and they've supported them with their free cash flows in 4 of these 5 years. 2019 was the only exception for the business. However, in these other years, and really since the COVID-19 pandemic, UPS has very easily been able to support their dividends with their free cash flows. And as we learned, it looks like the company is using a very reasonable amount of debt in their business. So especially more recently, it looks like the company's dividend payouts have been in pretty good shape based off the company's free cash flows. UPS did significantly hike their dividend in their most recent fiscal year, so that's something you'd want to be aware of here as well. Keep in mind that this is a snapshot of their last 5 years of performance, and so while this can be helpful, this is no guarantee for the future. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze UPS, which takes us on to using a discounted cash flow model to come to a potential intrinsic value for UPS. So a discounted cash flow model is based off the predictability of a business's free cash flows, and it's just like any other model in any other discipline, its outputs are going to be sensitive to its inputs. So here we're starting with UPS's current free cash flows and using historical growth assumptions based off how the business has grown these free cash flows, dating back all the way till 1990 in order to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions will be accurate and applicable going forward to give us a baseline projected estimate for UPS. If we assume that UPS can grow their current free cash flows at a rate of just under 7% annually for the next 10 years, then during the 10 years out after that this growth rate would be cut in half. If we add in the company's tangible book value, which gives us a perspective of their net worth, and we were seeking a 15% rate of return, which is the rate of return that Warren Buffett is looking for from his investments, in addition to his margin of safety requirements, then it looks like at today's valuations of UPS that a potential fair intrinsic value for UPS is right around $117 per share. So that's down more than $60 from the company's current stock price, and it would look like the business, if you wanted this higher rate of return, would be trending toward being more overly valued than fairly valued. There are a couple of points you'll want to keep in mind here. One is that this 15% rate of return would be including their dividends, so we would not be doubly counting their 3.4% dividend yield here. Also, UPS has tended to have very strong business predictability in the past, so while that's probably a good thing for the business, that's not necessarily a guarantee that continues on into the future. So please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for UPS, but we have to address something first. What are some of the qualitative aspects of this business? Starting with some of the key qualitative aspects around a potential long thesis for the company. Number one, on top of superior parcel density, UPS uses many of the same assets to handle both express and ground shipments, driving industry-leading operating margins. Number two, UPS's massive package sortation footprint, immense air and delivery fleet, and global operations knit together a presence that's extraordinarily difficult to replicate. And number three, despite near-term normalization off lofty levels, UPS's US ground and express package delivery operations should enjoy positive long-term tailwinds from e-commerce growth. Then for some of the key points around a potential short thesis of the business. Number one, Amazon has been building out its last mile logistics capabilities, which raises the risk that it continues to bring in-house more of the last mile packages it sends via UPS. Number two, UPS's National Masters Agreement with the Teamsters expires July 31st of 2023. Upcoming negotiations could prove contentious and lead to materially higher than anticipated wage inflation. And number three, normalizing e-commerce trends, sluggish retail sector restocking, and softening industrial end markets will likely create volume headwinds through the first half of 2023 for the business. So hopefully that offers a balanced perspective around some of the key qualitative aspects of the business. Now it's time for our summary. So UPS checks the box on 5 out of our 6 metrics today, meaning that this business looks like a very strong candidate for further research. They earn significantly above average returns on capital, coming in at 27%. They've grown their revenues, earnings, and free cash flows pretty strongly over the last 5 years, while just marginally diluting shareholders. It looks like the business is strongly cash flow generative relative to the debt that they're employing, and an average free cash flow to enterprise value yield of the business looks like it's right in line with the yield of the 10-year treasury, while on a current basis, it does look like UPS may be offering a slight risk premium. Looking at their dividend profile, it looks like especially since the COVID-19 pandemic, that the business has healthily and easily been able to support their dividend payouts with their free cash flows, and they've grown their free cash flows in all 5 of the previous years. They did massively hike their dividend in their most recent fiscal year. And finally, performing a discounted cash flow analysis of UPS, if you've done the work and you believe that those historical growth assumptions will be accurate and applicable going forward into the future for the business, then it looks like at today's valuations of UPS, that a potential fair intrinsic value for the company is right around $117 per share. So the last time that the business traded around those levels was back in July of 2020. It's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment, please consult with your financial advisor. This analysis serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about UPS. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company, understanding what's important and what's not important for the business going forward into the future. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of UPS, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of United Parcel Service Inc., ticker symbol UPS, UPS. We looked at the business today as a subscriber request, and it looks like because they checked the box on 5 of 6 of our metrics, that UPS is a very strong candidate for further research, so I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about UPS with me, and have a great day.